Well, welcome back. This has been a fantastic day so far. We've had wonderful discussions, and we have a fabulous panel to summarize where we are and what's happening. We've seen massive mobilization of the finance community in response to climate change. We've discussed portfolio construction, ESG disclosures, climate stress tests, and now climate risk sharing and insurance. But we're left with a question of whether mobilizing the finance community is sufficient to achieve our climate goals. Can the private sector do this without the government? The title of this session, Is It Enough? And if not, what's needed? And for example, will Biden's plan be enough? Our panelists today come from three different perspectives. We have an academic perspective, we have a nonprofit research perspective, and we have a practitioner investment perspective. Although all three of our speakers have crossed the aisle many times. So I'm not sure whether we can really distinguish their views. Let me briefly introduce them, and then let's take a look at this big question, is it enough? Bill Nordhaus is the Sterling Professor of Economics at Yale. He's a member of the National Academy of Sciences, a fellow of the American Academy of Arts and Sciences. He was president of the American Economic Association and has been editor of leading journals. He actually won the Nobel Prize too in 2018 for integrating climate change into long-run macroeconomic analysis. So first of all, welcome, Bill. Our second panelist is Richard Newell. Richard is the president and CEO of Resources for the Future, which is an independent nonprofit research organization that improves environmental, energy, and natural resource decisions through impartial economic research and policy engagement. It's been in existence for a long time. It's a long-time leader in environmental policy on lots of topics, and has had a major impact on U.S. policy making over generations. Before this, he served as, among other things, administrator of the U.S. Energy Administration. And the third panelist is Bob Litterman. He's the chairman of the Risk Committee at Kepos Capital, and prior to that, he was at Goldman Sachs for 23 years, where he was involved in research, risk management, investments, and lots of thought leadership roles. He has recently taken on the difficult task of being chairman of the CFTC Committee on Market Risk Subcommittee, and produced a very instrumental document which has really transformed the discussion on climate change. He is on our advisory board, and he is extremely influential in all aspects of this climate debate. So let me just go through and have you each take a quick response to the question, is it enough? See where we start. Bill, do you want to start?
I would be glad to start. What are you looking for? 5 minutes, 10 minutes, 1 minute?
Yeah, 5 minutes is good.
Okay, great. Let me say I'm delighted to be here. I've heard many, but not all of the panels, and learned a great deal. And I'm also delighted to be on with my other three co-panelists. So the first point I think comes out today is that private activities have a lot to do. Private actions can make a lot of difference, particularly of insurance. Insurance is about tail events. One of the things we've learned in recent years is fat tail events are important, earthquakes being one of the important areas. So even before we get into the public responsibilities, private sector, financial markets, but other areas have a lot to do. And we know this because because the studies of firms like McKinsey in their estimates of the cost of carbon reduction find that there's substantial amount that can be done at essentially zero cost. So those are the kinds of low-hanging fruit that can be done and can be done without hurting the profits of individual companies. But will it be enough to meet our goals? And let me say first, I think it's very important. I think it's not enough, but it's important. It's very important that these institutions get on board. First, because of the many low-cost things that they can do to help reduce emissions. And secondly, to support the public effort, because getting people to understand it's an important problem requires the support of many communities, not just academic communities and students, but people who actually can meet a payroll and have some funds. But realizing anything near our 2°C goal will require collective action. I just want to emphasize, it's going to require collective action of not just the US government, but many governments. And why is that? Well, the first and most important reason is even if financial institutions, say all the investment funds of the world were to get behind it, they don't really cover the entire economy. The corporate sector of our economies in places like the United States are about half of GDP. And even that some of that's private, not public investment. If you look at the European Trading Scheme, which covers their CO2, it's measured the large sectors, but it covers less than half of emissions. So there's their governments, their commercial establishments, their households, their small firms. And so it has to go beyond, even the best of financial governance cannot cover them. And then so what is needed? Well, pretty simply collective action, and collective action requires two steps. It requires carbon pricing to make sure that everybody, not just the big firms, but also the households and the governments, face the true social cost of their emissions. And I think that's well recognized, probably in this community, extremely well recognized. But it also probably not so recognized is the need for enhanced support of low carbon research and development by governments. We know there's a big spread between public and private returns to research and development. There's an even bigger gap for low carbon research and development because of the mispricing of carbon. So that is a very important further step of collective activity. So summary, yes, it will help for these different communities to get on board, not just the people who are the analysts and the economists, but also, and the students, but also the financial institutions, but it's not going to be enough.
Okay, thank you. That's the first vote on this. Okay, let's have the second vote on this. Richard, do you want to take over?
Sure. Yeah, thanks, Rob. It's real pleasure to be here. So I interpret the question, is it enough, as being whether actions by investors and financial institutions to properly assess, disclose, and price climate risk, and then take information and make smart, well-informed investment decisions, whether that's enough to solve the climate challenge. And the short answer is absolutely not. And I'm pretty sure that the audience also understands that. So, climate change is, I think, arguably the biggest externality, humanity has really ever faced. And as an externality, private incentives in the marketplace are not going to solve the problem on its own. Policy is essential to reflect the value of a stable and healthy climate in decisions really across the board. And so that brings me to a few other important characteristics of the climate crisis that warrant a systemic response on multiple fronts. First, the challenge touches the entire economy. Energy is an essential, pervasive economic input. Currently, 80% of our energy, both in the United States and globally, is still powered by fossil fuels. The energy sector is also responsible for more than 80% of all greenhouse gases in the United States. So change across the entire economy will have to be pretty transformational. Also, while the energy sector comprises 80% of greenhouse gases and 97% of carbon dioxide, it's not just about the power sector, which is where much of the focus tends to be. Electricity in the United States currently comprises about 1/4 of US greenhouse gas emissions, and it's now number 2 after transport, which is about 30%, industries another 23%, residential commercial buildings are about 12%, and agriculture is another 10%. So this means we need policy that really cuts across many sectors, and we need a wide variety of technological options appropriate to each sector. And so I would definitely echo what Bill Nordhaus has said on the need for technological advance. Another key factor is that the challenge is intergenerational. The relevant timeframe is very long. It requires stable policy frameworks. It requires decisions and investments that can withstand the bumps and potholes of many decades to come. And third, it's global. While it's essential that large, wealthy emitters like the United States take the lead in reducing emissions, investing in innovation, galvanizing international cooperation, we are only 15% of global emissions. And so we therefore need to take a global view on the problem and ensure that our actions leverage actions by other countries. So to support these efforts and address multiple challenges of this externality, we have to employ a systemic policy, not just financial policy, which is important, but also environmental and clean energy policy in order to meet the challenge. So this definitely includes economy-wide policies like carbon pricing. But increasingly we see that carbon pricing is not currently and is unlikely to be the single policy solution to this problem. So there's also a need for sector-specific incentive-based policies, like clean electricity standards, policies that support innovation, such as investments in research development, demonstration, deployment, and also increasing importance to addressing distributional impacts, like policies and programs that support economic transition for displaced workers and communities, and also address environmental justice issues. It's quite clear that the benefits of action dramatically outweigh the costs of action, but the distributional impacts, who wins and who loses, is a key element of the climate policy challenge and is something that we need to pay close attention to. Finally, I'll mention just one thing, the CFTC report in 2020, which I'm sure Bob Litterman will speak to, it started with a fundamental finding that financial markets will only be able to channel resources efficiently in a way that reduces greenhouse gas emissions if there's an economy-wide price on carbon that is at place in a level that reflects the true social cost of those emissions. So I think there's been a lot of discussion today about the importance of a sustained price on carbon. We also want to say a little bit about the social cost of carbon, and maybe we can come back to this in kind of later in the discussion. Bill Nordhaus is a real innovator in our thinking on this, and it's really what led to his Nobel Prize. So the social cost of carbon is a dollar estimate of the economic damage of every additional ton of carbon dioxide or other greenhouse gases put into the atmosphere. It's currently used by the federal government, the state governments, other subnational governments, and other companies and governmental bodies internationally. And it has informed billions of dollars in policy and investment decisions. The Biden administration made reestablishing the working group on the social cost of carbon a day one action, and final revised estimates are due at the beginning of next year. So I'll just close by saying I co-chaired a National Academy of Sciences committee back in 2017 that tasked the scientific community with reflecting the best available science in the social cost of carbon. And I'd argue that the social cost of carbon is quite possibly the most influential evaluation available to inform future action on emissions. So I'll close there. I can say more about this later, Rob, but I should probably stop for now. Thanks so much.
Great, thank you. Very interesting, influential response. Bob.
Thank you, Rob, and thank you and Dick for putting together this conference. It's been really fascinating. With respect to the question of is it enough, I'm not going to disagree with Bill or Richard. That would be a little dangerous, I think. But anyway, faced with the escalating climate impacts, investors are demanding climate risk disclosure and regulators are moving to require them. Well-structured disclosures of climate-related risks would help investors reduce their exposure, maintain efficient markets by pricing specific climate-related risks appropriately, and motivate investors and others to work to mitigate systemic risks as well. To achieve those ends, risk disclosures must reflect the true risks as accurately as possible and be designed so that risk can be directly compared across different potential investments within an asset class and industry. To ensure this, financial institutions and regulators should require that not only climate risks, but also the data, models, and methodologies used to determine those risks be standardized based on state-of-the-art science and, above all, be transparent. It is encouraging that financial regulators are starting to take climate change and climate risk seriously. In the months since the CFTC published its report, Managing Climate Risk in the U.S. Financial System, the Federal Reserve has joined the Network for Greening the Financial System. The New York State has issued guidelines. The SEC recently requested input from investors, registrants, and other market participants. And most recently, the CFTC announced the establishment of an interdivisional climate risk unit to assess the risks to the U.S. financial stability posed by climate change. Now, while there's always need for improvement, scientists today can model the rapidly evolving risks from perils like flood, wildfire, extreme heat, and more with meaningful accuracy. New methods allow scientists to connect these perils to economic risks over the next few decades. Given the novelty and complexity of these analyses, it is critical that disclosure be based upon transparent and publicly accessible assumptions, models, and data. Without this requirement, risk disclosures may be inaccurate, misleading, or impossible to interpret and compare between firms. Here, the SEC and others can make meaningful contributions by requiring uniform and clear standards of disclosure. Accurate risk disclosure would make markets more efficient, but would not directly contribute to reducing systemic climate-related risks. These risks include loss of wealth resulting from repeated weather-related disasters and political instability from climate-induced migration, negative impacts on health, not to mention the potential cost of atmospheric carbon dioxide removal. To manage these and other systemic risks, we must take steps to manage climate change itself by controlling the amounts of greenhouse gases in the atmosphere. These measures should be based on not just expected outcomes, but also plausibly extreme scenarios for how the climate responds to emissions, how much it costs to stabilize the climate, and how society responds to upheaval. As global society, we should have reacted decades ago to the threat of climate change. Because we did not, losses and risks are significant and are increasing rapidly. The present value of the future global unavoidable costs are likely already being measured in the tens of trillions of dollars in the best case. No one has any confidence about what worst case scenarios might cost. We cannot undo the past, but the cost of further delay is an irrational, expensive, and growing per unit of time increase in this risk management liability that our generation has already bequeathed on future generations.
Terrific, thank you. So it's pretty clear that all three of you agree, and I suppose it's pretty obvious that I do too, that more is needed than what we can expect from the private sector with improved financial management, disclosure, and regulation. So let's think a little more about what it might be. And actually, one of the things that is pretty interesting is all these voluntary commitments to net zero targets by companies, also by governments. And it's not so surprising by governments, but many companies have done this. There are, last week, there were something like 1,300 global companies listed on the UN website in the Race to Zero who have committed in some way to net zero targets. Turns out that only 217 of these are US companies, and of these, we were able to match only 143 in the CompuStat database. Nevertheless, these are large and generate more than about 20% of aggregate employment and revenue in the US. For full disclosure, I should mentioned that there are almost none of them in either the energy or the utility sector, which might not be a surprise when you think about it. But I guess I'm wondering, is this a direction for collective action that can be encouraged or enforced in some sort of way? I don't know, Bill, what do you think? You're still muted, I'm afraid.
I think there's a kind of fallacy of composition here that you have. I mean, I'll just take my own university. We're going to probably go to net zero at some point, and we know we're not going to do it domestically, so to speak, and we're going to buy offsets. And so all the other people are going to buy offsets, but we don't know where those offsets are going to come from. The question is, if we're going to do this, are we going to have net zero from everybody by 2050? Someone's going to have to be either producing negative emissions, or the economies are going to have to go to zero. So I think that people are looking at that, but they don't actually know where these emissions are going to come from. So I think that people are just not thinking through, well, why should a university president know where the offsets are going to come from, know whether there are enough offsets and enough trees and enough direct air capture to do it. So I think this is a kind of race. It's a kind of race to zero that hasn't thought through where it's going to come from, except that most of these companies and most of these universities know that they're not going to do it internally.
Okay.
Rob, do you want others to jump in, or you want to move on to something else?
Yeah, no, I'm happy to have you jump in, because that's.
So
please.
I'll offer maybe just a contrasting viewpoint. So as we being the analytic community, the international community, there has been a transition from focus on things like, global concentrations of greenhouse gases, or degrees of temperature change, like in the Paris Agreement, to avoid 2 degrees or 1.5 degrees. And I actually think the mapping of that and the translation of that to net zero by some point in time is actually quite helpful in terms of motivating practical action. The reality is that none of us has a dial on global temperature, but we do have the ability to change emissions, both at a national level and even at a corporate level. So I think the basic notion of net zero emissions is actually fundamental to the climate challenge. The goal that every country's agreed to is stabilizing greenhouse gas concentrations in the atmosphere. To do that, you need to get to net zero. So that part of it is actually quite simple and kind of unavoidable. I think Bill's point about putting a particular time target on that and how will individual companies do it, I think those companies themselves will readily recognize that most of them do not know how they will get there. I think some in the utility sector have a pretty clear path to 80% reduction or something like that. But I think the coalescence of both countries and companies around a notion of net zero by mid-century, I actually think is quite helpful in trying to provide focus toward an endpoint about where the economy might be headed.
Bob, you have some thoughts on this from our discussion before, and particularly, how can financial innovation help to channel capital at the scale that's required to actually meet some of these net zero requirements, and how institutionally could that happen?
Well, okay, let me first address the first question, and then I'll come to the second about how they, so I think it's very important along the lines that Richard was suggesting that we distinguish the different types of climate-related risks, in particular, the specific risks that are faced by corporations and which they are going to disclose versus the systemic risk. And with respect to climate, I think it's important to really drill down a little bit on what we mean by systemic risk, because usually when we think about systemic risk, for instance, to the financial system, we're talking about when the whole system contracts jointly and we need the federal government to step in and provide a backstop. In this case, I think we have to go well beyond that. That's not the systemic risk from climate change. The systemic risk from climate change is it bankrupts the entire world economy. And really, it's not a contraction that is reversed by federal government backstop. The question is what happens when the federal government can no longer backstop because it's had too many of these climate-related emergencies. So I think we're really talking about the worst of the worst cases. That's the systemic risk of climate. It's not the specific risk. It's not risks that are hedgeable. It's the unhedgeable risks. And the only way to address those is to put an appropriate incentive in place to reduce emissions. And we need to do that immediately. So what that really becomes is a question of how quickly are we going to get onto this road toward net zero? Is it going to happen by 2050 or 2060 or whatever? We had earlier today a discussion from is it Marcin Kaspersik, I think, who talked about the different IPCC scenarios. And indeed, I think that's really what we have to worry about is which of those scenarios are we on? When are we going to price risk appropriately? And if it's more quickly than people expect, that's going to have impacts on valuations and lead to potentially transition risk. Now, what can financial markets do to help increase the flow of capital toward the net zero economy? Well, as we said in the CFTC report, the first and most important thing is we got to put a price on carbon. So we have to create those incentives. But beyond that, and I think where the financial market can really be very helpful is with respect to the relatively low cost, low hanging fruit, which is to say natural climate solutions. That is to say, reforesting, degraded lands, for instance, things like that. And these are the things that we should be doing immediately because they're the cheapest ways to reduce carbon. And what do we need to do to get that at scale? These today are sometimes called the voluntary carbon markets, and they have very low prices. You don't find investors investing in them. You talked earlier about the carbon ETF, which is an average of the compliance markets. Those are not voluntary markets. Those are markets where you're required to pay for credits for polluting. And what we really need to do is, and those, by the way, you were suggesting, or he was suggesting, and I agree, are excellent investments. A lot of these markets have minimum guaranteed auction levels, and the EU markets have been appreciating very rapidly. In California, you have essentially a 5% minimum auction price increase per year, plus basically a free option on upside if markets, if prices rise more rapidly. And the question is, can we create that same upside potential for what's today called the voluntary market? And that requires two things. One is we have to create the standards that will make those so-called credits, of minimum supply. Investors worry that there aren't enough standards so that there'll be unlimited supply and therefore a low price. And so if I'm not going to get an appreciation, I'm not going to make an investment. And then you need additional demand. So you need those compliance markets to accept high quality credits from the credit markets. And the thing in addition where the financial markets can really help, think of those credits as being risky promises to reduce emissions at some time in the future. It's a little bit like a mortgage. Mortgage is a risky promise to pay off a debt. Well, here you can use similar structuring of these credits, providing insurance backups as well as different tranches of pools of these credits so that different investors with different risk profiles will find different attractive investment opportunities. And if we can create additional expectations of demand and reduction in the supply of low quality credits, then we can make this a very attractive market for investors. And that is to say, we can really increase the flow of investments into these low cost ways to reduce emissions. Sorry for that long answer.
No, I think it's a very interesting development. I mean, the whole idea of negative emissions is a pretty powerful part of this. It's just that it's a little hard to to clarify exactly what you mean by that and what counts and what doesn't. But negative emissions are just as good as reductions if they're really if they really exist. And so,
well, absolutely. If you're willing to pay, someone, if you're willing to charge someone, let's put it that way, whatever, $40 a ton for emitting CO2, you ought to be willing to pay someone $30 a ton to pull it out of the atmosphere, right?
absolutely. I mean, I think that's how we deal with Bill's concern that really they're just some carbon emissions which are going to be impossible to mitigate. So this is what we hope for. So one of the and so if we're headed in this direction, there's a shadow price on carbon, which would come out naturally from some kind of a compulsory approach to net zero. And I wonder how that would compare with the social cost of carbon. And I don't know whether you've thought about that, Richard, but I suspect you have, because you guys are all over this problem. So what do you think?
Well, there's a couple of things that might be useful to bring up and that I think are particularly relevant to climate financial risk and may not be readily evident to everybody. So as I mentioned earlier, I was engaged back in 2009 to 11 when the Obama administration put together an interagency working on the social cost of carbon, relied heavily on existing integrated assessment models like Bill Nordhaus's DICE model at that time. And then in 2015 to 17, I co-chaired a National Academy of Sciences study that put forward a number of different recommendations for how we can improve those methods to ensure that those estimates, continue to rely on the best available science and, innovate over time. So there's two major facets to the recommendations. One was to create a transparent and well-documented open source computing platform so that all the different parts of the scientific community that are relevant to estimation of climate change and climate damages would have a platform to come together. And the second major area was a set of specific improvements. And there was 4 key areas here. So you think about the 4 key pieces of estimating a present value of the damages from a ton of CO2 emissions. There's the emissions entering into the atmosphere, so the buildup of atmospheric concentrations, which is driven by population, by GDP, by energy, by emissions, right? So there's that piece, socioeconomic and emission projections. The second piece is models of temperature change and other climate variables. So how much temperature change, how much sea level rise, how much ocean acidification will occur as a result of those emissions. The third is estimating and monetizing the damages that come from that physical climate change. And then the fourth is discounting and aggregating those impacts over time into a single present value. So each of these different 4 key components of the social cost of carbon, there's efforts underway. We've had an initiative at RFF for the last 4 years on this, working with other institutions globally. I think it's probably evident how this is relevant for estimation of physical risk, because after all, the social cost of carbon is meant to add up those damages from climate change. But it's also relevant for transition risk. And the reason is that the way that we've been approaching this is through a true probabilistic approach. So the issue of scenarios has come up throughout the day, and most scenarios for climate and other things they don't have probabilities attached to them. They're like, high climate, low climate, medium, 1.5, 8.5, et cetera. So what we're doing is we're actually attaching probabilities through both statistical estimation and structured expert judgment to all elements of this problem. So that's going to be relevant also for transition risk, because the front part of this, which is the socioeconomic and emissions projections, we're making use of the best available macroeconomic forecasts of GDP at a country level and globally, population forecasts that are, again, probabilistic, and then also emissions and energy projections that are probabilistic in nature. And part of this is also going to involve expert judgment about how policy may unfold and how actions by countries may unfold. So I think this is going to be very relevant for climate financial risk, both on the physical and the transition, as as investors want to put, I think, not just a range of scenarios, but actually have probabilities and distributions attached to that.
Could I just add one word to the last two, Rob? I just want to emphasize the disconnect between all the things we're talking about. The disconnect between our goals in terms of, say, the price of carbon, our goals, the social cost of carbon, the Paris Accord, and where the world actually stands. So if you ask, you asked, what kind of price would we need to get to the 2-degree goal, which is the goal of the Paris Accord? Probably in the $100 to $150 a ton range, if it's done efficiently through pricing, not by regulations, and if it's done essentially universally, not just in a few countries. That contrasts with the social cost of carbon that's used, say, by the federal government, which was essentially the result of a cost-benefit analysis of different models, but actually didn't have a temperature goal in it. And that might be in the 30 to, depending on what numbers you use, the $40 to $50 per ton range now. So roughly, let's say 1/3 of the social cost of carbon, or the price of carbon, you need to get to the 2-degree target. Then let's look at the Paris Accord. And the Paris Accord, if it's implemented, is probably around a $30 a ton price today. So below the social cost of carbon, way, way below the 2-degree target. And then if you look at the actual price of carbon around the world, it's about $2 to $3 if you omit the subsidies, and it's probably -$8 if you include the fossil subsidies. So these, and then there's the Paris, not as advertised, but actually implemented, which is somewhere down in probably in the teens or so. So part of the problem is then we've got this big disconnect between our policies, our goals, our reality, and then also the fact that we're not on the road to doing carbon pricing. And if we were going to do these inefficient policies, would be up by another factor of 2. So I just want to emphasize the incoherence here of our policies, even at the federal government level in calculating the social cost of carbon, which is different from the goal that the federal government has actually put in the Paris Accord.
I agree with all that, Bill.
Yeah, right.
The only thing I would just quickly add, and Bill's absolutely right, that the need for action as put out in various international agreements, the disconnect between that and the action that's already in place is dramatic. The only additional thing I'd add is that the estimate of the social cost of carbon, a very key ingredient there that can change it significantly is the discount rate. And using all the same methods that Bill just alluded to, the current estimate is $51 per ton by the US government. If one was to use a 2%, just as an example, if one was to use a 2% discount rate rather than a 3% discount rate, it would be $125 per ton. So I don't think they're actually, depending upon the assumptions you make there, I'm not sure that the disconnect between social cost of carbon and the kind of price necessary to get to certain goals is actually that large. Still a question of implementing those policies, but I just wanted to make that point.
Yeah, and Bill, I'm not so sure we're that far away from pricing carbon. You know, if you look at who's supporting the bipartisan effort of the Climate Leadership Council, it includes everyone from, you know, ExxonMobil and the other major oil companies. API just joined, the Chamber of Commerce, the National Association of Manufacturers, you know, virtually the entire corporate community, the financial community, the academic community, and, you know, virtually every economist out there. So it's true that we've had a little bit of political problems in Washington, but you know, that could change very quickly.
Yeah, and I agree with that. I mean, we can be hopeful, and once it starts, we've seen in other countries that once you go down that road, Canada is a very interesting example. Once you go down that road, then if it's well structured, as in British Columbia, for example, where it's a tax and refund, it can become pretty popular, and it can become just. Unlike regulations and cap and trade, which are actually quite unjust. So, but I think just one final, but I think we have to, I feel very strongly, maybe incorrectly, but it's not carbon tax or something else. It's carbon tax if you want to come close to your goals. You can do other things, but you're not going to get, you probably end up with 4 or 5, we'll probably end with 3 degrees and maybe 5 degrees after 150 years. But you're not going to get close to your goals if you start substituting ineffective policies, regulatory policies, voluntary policies. It's just, doesn't have the teeth you need in the different countries, the different sectors, all the different actors, even governments to do it.
Right, right. And the CFTC subcommittee was unanimous on this point. We all understand that we need incentives. And, you know, we said that's urgent and important. Can't get there without it.
And you haven't mentioned yet the importance of the risk perspective that comes in here, where, I mean, we saw in discussing stress tests for banks today, there was the notion that the climate effects are inevitable and predictable, and we're not really talking about risk. We're just talking about whether people are willing to account for that. That leads you to somewhat different views to what the optimal policy and the optimal tax rate should be, I suppose.
I'll just say one word on that. There's a long and deep debate that this panel knows about whether the various elements of climate change are a fat-tailed system or just a somewhat skewed system. This is something that Martin Weitzman started maybe 10 years ago or so, and it's deep and it's unresolved, and that would very much change not just a little skewness, which is easy to handle, and the modeling does handle now. The modeling does have uncertainty in it. Most of the models do, but whether this is actually a fat tail distribution of the Pareto Levy that we see in stock markets or in earthquakes, that really changes things dramatically. But that's an open issue in climate change. I think it's just, we don't know.
No, we don't. And we have to prepare for worst case scenarios.
Worst case, we have to prepare for
that's risk management. You know, you can't hope it's not there.
Yes. Yeah. Yes.
I thought it would be worth just touching on that topic. I think there's more agreement than disagreement among the panel. I think this is probably a good time to stop, unless there's some other pressing point that someone wants to make. I think it's been a fabulous way to conclude today, because I think everything that we talked about today is working toward improving our adaptation to climate change, but it's not really approaching the mitigation problem in a very strong way. And so we need both. And I think that's the message, and I wanted that point to be made, and I think you've all made it very well.
Good.
So thank you.
Thank you.
Thank you.
Pleasure. Thank you.
Take care.